Hello everyone. So welcome to my YouTube channel, Financial Markets by CA Sandip Agarwal. So this is video number 4 under Options Intermediate Part 1, and this is like the 8th video under the total option series. We have already covered 4 video under the Options Basic, and this is the 4th and the last video under the Options Intermediate Part 1. After this video, we will move to a more advanced version and we will cover another 4 to 5 videos in the options intermediate part 2, and then we will move to the professional part where we will have another 4 to 5 videos, and this will cover the entire uh, nuances of the options. I hope you people have been liking my content till date. In case you are liking, please like and subscribe to my channel so that you can receive notifications for any future videos which would be uploaded, and also share the content with your family and friends in case you feel that this will add value to those as well. So let's start. So this 3-4 slides I am again repeating because in each of these videos these concepts are required in order to understand the contents in this video. In case you want to understand it again in a detailed manner, you can refer to my videos in the options basic series. The link of all those videos you will find in the description box of this video. So like as I explained, there are basically 3 types of market. One is bullish, where the person expects the market to move in the upward direction. Another is bearish, where the person expects the market to move in the downward direction. And another is sideways, where the person expects the market uh, to either move in a very tight range or to remain at the same level. Then these are the uses of the options as we explained earlier in my videos under the options basic, that the options can be used for the purpose of hedging your portfolio, for the purpose of speculation, and for the purpose of hedging as well as for generation of income. All the strategies which we have discussed in the options intermediate as well as in this video are basically covered under your speculation version only, because there are very limited options in the hedging part. So almost all the strategies in the market are basically of speculative nature only. So we have 2 types of option. One is American option, another is European option. In India, we have only European option. Now under the European option, you have call option and put option. Under each of these call and put options, you have 3 categories of option. One is ITM, which is in the money. Another is ATM, which is at the money. And third is OTM, which is out of money. So in this video also, we will cover only the discretionary and the speculative strategies which can be used in all types of market, bullish, bearish, and sideways. So till now, we have mostly covered all the vertical strategies because most of the strategies in the market are of the vertical nature only. So in this video, we will also cover one strategy of the calendar spread as well. So this will help us to cover all the strategies under the vertical and the calendar spread, which are mostly used in the market. So till now, we have covered various kind of strategies. One was bullish call spread, another was bear call spread, then bearish put spread, bullish put spread, and we have also done like long and short straddle, strangle, iron fly, iron condor. So in this video, we would be discussing bullish Seagull and the bearish Seagull strategies. So these strategies are also falls under the vertical spread strategy. So what is bullish Seagull? So bullish Seagull is basically the person expects the market to remain bullish, but at the same point of time, the person wants to reduce the cost of the strategy which you would be applying in the bullish strategy. So if a person buys an at the money call option and sells the OTM call option, this is called bull call spread, which we have covered in the video number 1 under the options intermediate. Now, obviously, this will have certain costs to be paid upfront. And in case the person wants to reduce this cost, which he has paid upfront, or he wants to zeroize this entire cost, so then the person does, so he basically sells another ATM put option or he sells OTM put option, and thereby reduces the cost of this full call spread, and this converts the bull call spread into the bullish Seagull structure. Now, this strategy is basically a variation of the bull call spread only, and it covers a limited risk and limited reward strategy of the bull call spread into unlimited risk and the limited reward strategy. So even though the cost of the structure gets reduced under the bullish Eagle strategy, but the risk component also gets increased. So we will explain this with the help of an example and the payoff graph in the next slide. So let me just zoom this. So this screenshot I have basically taken from a website called as Obstra Define Each. You can also register in that website at a no cost basis, and you can also simulate the various scenarios and the various strategies which will add value to the knowledge which you have gained through seeing my videos. So this example I have taken at the time when the Nifty was trading somewhere around 16,600. So this entire example is on the basis of an underlying instrument called as Nifty index. So you can see in this strategy what I have done. I have basically bought a 16,600, a call option of the 31st March expiry, which is trading at 508 rupees. And I have sold an OTM call option of 31st March 2022 expiry at 115 rupees. So if we consider only the first two taps, so this is a bull call spread where the person has bought an ATM call option and sold an OTM call option. We can see the net premium outflow would have been 400 rupees in this case. And the maximum reward is 600. That is 17,600 minus 16,600 is 1,000 minus 400 upfront premium which has been paid. So the maximum reward is 600 and the maximum loss is 400. So this is a defined limited risk and the limited reward strategy. But the person wants to reduce the cost of the strategy. So what this person does, the person adds to it a sale of an slightly OTM put option, which is 16,500 at 410 rupees. So you can see in this case, the entire premium paid by the person has been compensated by the receipt of the premium on the sold OTM put option. So you can see in this case, the net credit at the below of the screen is 867 rupees. So basically by deploying this strategy, the person has received the premium and not paid the premium. And we can also see the maximum profit which the person can make. So since the premium has been received by the person of 867 rupees, so in case the market starts moving in the upward direction, which is the bullish scenario which the person is expecting and has deployed this strategy. So the entire movement between 16,600 to 17,600, which is around 1,000 points, will be the profit of that person. So 1,000 points multiplied by 50 lot, which is the quantity for one lot of Nifty futures, is equal to 50,000. And he has also received an upfront premium of around 868 rupees. So you can see the maximum profit is 50,868 and the maximum loss is undefined. So we will just see this maximum loss as well by zooming. You can see in case the market moves in the upward direction, you can see his maximum profit is capped to around 50,868. Whereas in case the market starts moving in the downward direction, so even though the cost of this strategy was almost nil, where the person has received a premium of rupees 868, but since the person has sold a net 16,500 OTM put option, his risk becomes unlimited in case the market starts moving in the downward direction. So again, this was just an example to help you people explain the practical concept of the bullish eagle strategy. This is not a recommendation at all, and this is only an hypothetical example. So similarly, the person can also do a bearish Seagull strategy, which is basically an inverse strategy of the bullish Seagull strategy. In this case, the person expects the market to remain bearish. So he wants to deploy a strategy for the bearish market structure. But at the same point of time, he also wants to reduce the cost of this strategy. So the person basically buys an ATM put option and sells an OTM put option. This is called bear put spread, which is covered in video number 1 under options intermediate part 1. Now, in order to reduce the cost of this strategy, the person sells one OTM or ATM call option and converts this bear put spread into bearish Seagull structure. Again, this is a variation of the bear put spread, and it converts limited risk and limited reward strategy into unlimited risk and limited reward strategy. We will also see this with the help of an example and the payoff graph in the next slide. Let me just zoom it. So you can see similarly in this case, the person, instead of buying a call option, he has basically bought an ATM put option of 16,600 and he has sold a 15,600 OTM put option. So this is a bear put spread. The net premium paid by the person is somewhere around 280 rupees. So in this case, the maximum profit is around 720 rupees and maximum loss is 280. Now the person wants to reduce the cost of this strategy. So the person sells an OTM call option of 16,700 at 451 rupees premium. So the net premium received by the person, you can see at the bottom of the screen, is 8,350. So instead of paying the premium, the person has basically received the premium in this case. So again, the maximum profit in this case becomes the difference between 16,600 put option and 15,600 put option, which is 1,000 points, and the net premium receipt, which is 8,350. So the maximum profit becomes 58,350, and the loss obviously is unlimited. We will see this payoff graph as well. You can see the maximum profit in case of the downside is restricted to around 59,000 rupees, whereas in case the market starts moving in the upward direction, which is against the view of the person deploying this strategy, we can see the loss is unlimited. So even though the cost of the strategy becomes zero, in fact, the person receives the premium. Instead of paying a premium, he receives the premium. But you can see in case the market starts moving in the opposite direction which the person was expecting, so the loss can also be unlimited. This example again I have taken when the Nifty was trading at 16,600. So this is an example of the Nifty underlying index. One lot of Nifty is equal to 50 quantity. So this is again an hypothetical example only, and this is not a trade recommendation. This example also I have taken from Offshore Define Edge website. You can create a free account from that website. Now this is the calendar spread. So this I am covering it for the first time. So I will go a bit slow so that you can grasp the concept of the calendar spread. So calendar spread is also a type of a cost reduction strategy. So the person can have a bullish view or they can have a bearish view, and they want to reduce the cost of the strategy which is applied under the bullish view as well as the bearish view. So I will give you the example of the bullish strategy and then the calendar spread, and then as a part of an exercise, you can do the calendar spread under the bearish strategy with the help of the Offshore Define Edge website. So in this case, the person basically buys an ATM call or the ATM put option depending on the views of the market. Bullish, in case the person is bullish, he can buy an ATM call option. In case the person is having a bearish view, he can buy an ATM put option of the 4-month expiry. So like say currently we are in the month of the March. So the person basically buy a call option in case of bullish or buy a put option in case of bearish of the April month expiry. And at the same point of time, he can sell the same strike ATM or OTM call and put option of the current month, which is the March month. So this is called a calendar spread. So where basically the person has sold the call of the put option of the current month expiry and they have bought a call or a put option of the next month expiry. This is a limited risk and the limited reward strategy. So I will explain you with the help of an example why this strategy is applied and what are the expectations of the profits in this case. So I will just zoom it. So you can see this example I have taken when the Nifty was trading at around 16,600. So this strategy is basically deployed on an underlying instrument called as Nifty. So you can see the person has basically sold a 16,500 put option of March 22 contract expiry, and he has basically received a premium of 410, and he has basically bought a same strike price which is 16,500 of April 2022 Nifty contract, and he has basically paid a premium of 500 too. So on net basis, the premium which has been paid by him is 92 rupees. That is 502 minus 410 multiplied by 50, which is around 4,600. So you don't look at the maximum profit and the maximum loss in this case, since there are two expiries involved in this. So basically, this maximum profit and the maximum loss, the Opstar Define Age website calculates on the basis of the near month expiry. So this max profit and the max loss, they have calculated as on 31st of March and not as on 28th of April, since two expiry contracts are involved in it. So why the person applies this strategy? Now, let's say for an example, in the month of the March, when the expiry comes and the Nifty expires at around say 16,500 only. So this entire premium of 410, which was received on the sold put option of the March contract, will be received by that person. And this another 16,500 put option of April 2022 strike price will still be live at that point of time. Obviously, the price of the 16,500 put option April 22 contract will not be entirely 502. It can be more than that or it can be less than that, because it depends on the other option Greeks as well, on the basis of which the prices of the options are determined. But it will be around say 250 or 300, because the time value of the money will get reduced in the put option of the April 22 contract as well. So basically, in this strategy, you can see the loss is very limited, whereas the expectancy of the profit is very high in this case. So we can also have a question that why the premium of the 16,500 put option of the April 22 contract is higher than the 16,500 put option of the March contract. Why? Because the time value of money in the April 22 contract is much higher as compared to March 22 contract. The March 22 contract will expire first, then after 30 days, the April 22 contract will expire. So since the time value of the money is in April contract is higher, so that's why the premium is a bit higher. But as we move very closer to the March expiry, the option value of March 22 16,500 put option will start losing its value at a very much faster pace as compared to the 16,500 put option of the April 22 contract. So this is an added advantage in case of the calendar spread. The time value of the money the person basically receives on the sold option of the current month expiry, whereas the time value of the money in the far month bought option will not lose value at that high speed in the March month. It will lose value only in when we start approaching the expiry of the April 22 contract. So you can also have a look at the payoff graph as well. So this payoff graph will not come in a very correct manner, because the Opstar Define Age website calculates this payoff graph and the payoff amounts on the basis of the near month expiry, which is 31st March. So you can maybe ignore this one as well. You can just remember that the net premium which has been paid under this strategy is 92 rupees only, which is around 4,600. And whereas the profit can be unlimited also in this case. But obviously, when the person is applying this strategy, the motive of the strategy should be to square it off near the current month expiry contract. So when we are approaching the last week of the March expiry contract, or maybe 1 or 2 days before the March expiry contract, then it is prudent to square off this strategy. And it is seen generally on an average basis that this strategy gives a very good amount of money. But again, this is not a trade recommendation. This is just an hypothetical example to explain you the concept of the calendar spread. Why calendar spreads are used, you will get a very detailed understanding in the options intermediate part 2 video series, when I will start explaining how the option prices are calculated and how the options are selected. So why options? So generally, it is termed in the market that the options are overpriced. So it means basically the option selling makes money on an average, while option buying loses money on average. Now this is on average basis. So you can make money by option buying as well as option selling, but you need to understand when to buy the option and when to sell the option. But on an average, the option seller makes money more than the option buyer. But in case of the option buying, your risk is also always limited, whereas your reward is always unlimited. Whereas in case of the option selling, your reward is always limited and your risk is always unlimited. So the person has to be very careful in case of the option selling. We can recall the example of the insurance, which we have explained in detail in video number 1 under options basic, where an insurance company who is selling an insurance policy to the insured person, they are basically treated like as an option seller. So they are basically selling the insurance policy because they know that on an average, the amount of the claim which they have to pay to the deceased of the insurance policy holder is much lesser as compared to the combined amount of the option of the insurance premium received by them. So you can refer to the example of the insurance company. You can pull out balance sheet and the profit and loss account of any insurance company, and you can see they are always profitable on year basis. So on that basis, as well as you can also check out with any person who has been doing it on a practical basis, and you will come to know that the person who is doing option selling makes money on an average as compared to the option buying. So like as I told earlier in the beginning of this slide, it is not necessary. There are certain person who makes money in option buying as well as option selling, but the person needs to be clear when he wants to do the option buying and when he wants to do the option selling. Basically, options acts like an insurance. And once I start going into the options intermediate part 2, I will also explain this concept as well. The option selling makes money higher in case of the put options as compared to the call options. Why? Because put options are basically bought by the person for the purpose of the hedging. I am speaking this in general way, even though the person buys the put option for the speculation as well. But generally, the put options are made for the purpose of the hedging only. So that's why the put options are priced higher as compared to the call options. And you will see that the means the money in case of the option selling is made more in case of the put option. I will explain you with the help of an example as well. So just I don't have that example in this slide, so maybe I will cover it in the next video. So that's it from my side. I hope you people have liked my video. In case you have any queries, you can put those queries in the comment box and I will try to address it in the next video. That's it. Thank you.